I am pleased to make this presentation today on consolidated financial statements and the related disclosures covering IFRS 10 and part of IFRS 12. As you may be aware that with effect from 1st January 2013, International Accounting Standards Board issued a package of standards, some revised, some new standards replacing others, in relation to consolidation. Now, when we say in relation to consolidation, it covers subsidiaries, associates, joint ventures, and also the new IFRS 10 tries to capture specified unstructured entities as well. So we have to take these standards as one package which came into effect from 1st January 2013 internationally. But considering the complexity and probably the readiness and the issues that the preparers might face with these standards, the Accounting Standards Committee and the Council of the Institute took a decision to defer the application of this package of standards by 1 year. So as a result, these set of standards will become effective from 1st January 2014 in Sri Lankan context. So if you look at what are there in this package, we have IFRS 10 consolidated financial statements, which will supersede the current IAS 27 and the SIC 12. The current IAS 27 deals with consolidated financial statements as well as separate financial statements, and with the introduction of IFRS 10, all the provisions contained in IAS 27 relating to consolidated financial statements will move out, and what will be retained in that standard will be only the provisions in relation to separate financial statements. Then SIC 12, which tried to address special purpose vehicles, will also be superseded and will not be effective when IFRS 10 come into the picture. So with the change, or with this introduction, IAS 27 will be renamed and confined only to separate financial statements. Then IFRS 11, which is again somewhat a new standard, because when you look at the provisions, there are a whole lot of new provisions, which is on joint arrangements and replaces IAS 31 and SIC 13. So IAS 31, unlike IAS 27, will fully disappear with the introduction of IFRS 11, and all the disclosure requirements in relation to consolidation and joint arrangements will be compiled in one standard, IFRS 12, which is on disclosure of interests in other entities. So that will cover all the disclosures. So IFRS 10 and IFRS 11 will not address the disclosure issues. So all the disclosure issues of these standards relating to subsidiaries, associates, and joint arrangements will be covered now in IFRS 12. Then IAS 28, which was earlier dealing with investments in associates, will now be renamed as investments in associates and joint ventures, and primarily will focus on application of equity method. So those are the changes, new introductions, and new provisions And these few standards, IFRS 10, 11, 12, IAS 27 and 28 are interrelated, and there are so much of cross references. So that is why this is considered as a package of standards in relation to consolidation. Right. So when we look at this package of standards as a whole, if we summarize, if you have outright control of an entity, then you consolidate in accordance with IFRS 10. If you don't have outright control, then sometimes it could be joint control. Even though you don't have outright control, you might have joint control. So if you have joint control, depending on the type of joint arrangements, whether it is a joint operation or a joint venture, you will apply either IFRS 11 or if it is a joint operation, of course you will apply IFRS 11, but if it is a joint venture, you will have to apply a combination of provisions from IFRS 11 as well as IAS 28. So particularly in identify whether it is a joint venture, you will apply IFRS 11, and then applying the equity method for accounting, you will apply IAS 28 provision. So the two standards refer to each other in recognizing and measuring the interests in joint arrangements and joint ventures, joint arrangements which could be either joint operations or joint ventures. If you don't have joint control either, then you might sometimes have significant influence. So if you have significant influence, it will be treated as an associate, and you will apply IAS 28. Then even if you don't have significant influence, then it could be a normal investment which you would recognize as a financial asset and would be treated in accordance with IAS 39 and or IFRS 9. IAS 39 will apply till 31st December 2014, and IFRS 9 hopefully will be effective from 1st January 2015. But you may be aware that even at IASB level, IFRS 9 is not yet finalized, and there are certain issues. They have brought, even after issuing IFRS 9, recently they have brought in few amendments to IFRS 9, and they are still deliberating on certain aspects on recognition and measurement. So few more changes or additions can be expected to IFRS 9, and as it stands at the moment, the Council has decided to have it effective from 1st January 2015. However, depending on the things that would go on and depending on the amendments and additions that would come in and their complexity and the relevance and how the preparers would look at it, sometimes the ultimate effective date could be changed, but don't take it as granted, but be ready to apply it. But anyway, IFRS 9 is not a subject matter today in this presentation. So in the first three cases, on consolidation, or if it is a joint arrangement, or if you are applying associate principles, equity method, then all the disclosures are included in IFRS 12. So for disclosure requirements, you need to apply IFRS 12. Now, since the gathering is small, you can interact at any point. So if you have any questions, you can stop me and ask the questions, right? So if we look at IFRS 10 or SLFRS 10, it establishes principles for the presentation and preparation of consolidated financial statements. Now, this standard does not, now another standard, even though it is not a part of this package which came as a whole, IFRS 3 is another important component in the consolidation process, because IFRS 3 is the standard that applies in relation to consolidation at the initial point where the control is established or an acquisition is made. So once in relation to initial recognition, it is IFRS 3 that applies, and once you initially recognize, for subsequent recognition in relation to consolidation, IFRS 10 applies. So it was like in the earlier regime, we had SLS 25 for business combinations, which dealt with the initial recognition, and then SLS 26, which dealt with the subsequent recognition. So as I said, the standard supersedes IAS 27 and SIC 12, and now why this whole lot of revision or a revised standard was necessary? What was the problem with IAS 27? Why we could not continue with IAS 27? I would say the first unpublished reason for this new standard is the attempted conversion between US GAAP and the IFRS, because there were many significant differences between IAS 27 and the relevant US GAAP rules. So IASB initiated a project to reconcile these two, because you know IASB's objective is to have one single set of accounting standards for the globe. So the main barrier to have this one set of accounting standards for the globe is the US GAAP, the objections that are coming from US. So IASB always, in relation to new standards, now have a project to reconcile this with US GAAP. So this IFRS 10 is also a result of that attempt to have this reconciliation and have a standard which is commonly acceptable for both US and the rest of the world, even though I must say even IFRS 10 probably have not been able to meet that objective. Still US GAAP, US has certain issues with IFRS 10. The reason being, when we discuss the standard, you will realize that IFRS 10 is largely judgment based or principle based. Now US is generally not used to this practice. They are not used to making judgments. They are tickers. Take a checklist and tick. Okay. So IFRS 10 cannot be applied by using the ticking method. There are a whole lot of judgments that you need to make in applying IFRS 10. You will realize it. For example, in your handouts, there is a one handout containing several questions, and in most of those questions you will see that we will not be able to make a conclusion, because you need a lot of judgments to be exercised. Then apart from that, there was another issue, that is there was a divergence in applying IAS 27. Now particularly with the issue of SIC 12, there were almost two control models. Now if you take IAS 27, the control is defined as power to govern financial and operating policies so as to obtain benefits. So it basically mainly takes, the focus is on the control based on voting power. But SIC 12 takes the view or defines, it is specially addressing these special purpose vehicles, but it is going on the principle of risk and rewards. Not that IAS 27 is not looking at risks and rewards, but it is mainly based on the principle of control as power to govern financial and operating policies, whereas SIC 12 is focusing on, instead of financial and operating policies, the risks and rewards. Now, one other objective of IFRS 10 is to bring these two together and have one single control model. So, you will see IFRS 10 definition of control is having all these features which IAS 27 and SIC 12 had, and has one single control model. Then also a significant difference between IAS 27 and the related US GAAP was the recognition of off-balance sheet vehicles, particularly arising after the Enron debacle. So, IFRS 10 attempts to address the issue of off-balance sheet vehicles. So, that is another main reason for IFRS 10 to be issued in place of IAS 27. So, accordingly, IFRS 10 covers the broad areas of objective and scope. The most important area is principle of control, and then accounting requirements and definitions. When it comes to accounting requirements, I don't see major changes. Once you establish the control, then it is a matter of consolidation using the normal consolidation principles. But the main focus is on establishment of control and recognizing or establishing whether a particular entity is your subsidiary or not. Then IFRS 10 and also 11 do not attempt to address the disclosure issues, and disclosure issues are taken up separately in IFRS 12. So, IFRS 12 accordingly encompass all disclosure requirements in relation to consolidation, that is 27, associates 28, and joint arrangements 31, and IFRS 11. Of course, IAS 31 will be replaced by IFRS 11. So, the broad areas covered in IFRS 12, again objective and scope, significant judgments and assumptions, interests in subsidiaries, and interests in unconsolidated structured entities. So, two important areas that we need to focus is the significant judgments and assumptions. Now, IFRS 12 very much focuses on disclosing the judgments and assumptions. I said IFRS 10, in application of IFRS 10, a lot of judgments and assumptions have to be made. Now, disclosure of these judgments and assumptions is very important and is one of the focus areas of IFRS 12. Then on the other hand, when it comes to special purpose vehicles or structured entities, according to IFRS 10, even though there may be structured entities where you have an interest, where there is an impact on the investor, but may not be consolidated due to non-establishment of control. But if there are such structured entities which are unconsolidated, that is another important focus area in IFRS 12, to make sufficient disclosures in relation to interests in unconsolidated structured entities. So those are two important areas that you find in IFRS 12, which was not very much of a focus area in the other standards, in the previous standards, that is IAS 27 and 28. I will just run through these objective slides of IFRS 10 and IFRS 10, self-explanatory. Objective of IFRS 10 is to establish principles for the presentation and preparation of consolidated financial statements when an entity controls one or more other entities. And this objective is achieved by requiring a parent to present consolidated financial statements, by defining the principle of control, and addressing the application of principle of control, setting out accounting requirements, and defining an investment entity and setting out consolidation exceptions. Similarly, IFRS 12 also sets out its objectives. And the objectives are achieved mainly by requiring the disclosure of significant judgments and assumptions made in determining the nature of its interest and information about its interests in subsidiaries, joint arrangements and associates, and structured entities that are not controlled by the entity. So we'll look at details. That's just a summary of the objectives. So let's look at the scope of IFRS 10. The general requirement of IFRS 10 is no different to IAS 27. An entity that is a parent shall present consolidated financial statements. So the general requirement of IAS 27 was also the same. Every parent, subject to certain exemptions, is required to present consolidated financial statements. Now, another important factor that I would like to emphasize is that this IFRS 10 applies to a parent or to an investor, not to a subsidiary. It is the responsibility of the investor to see whether it's a parent or not. If you have any investment, now those days you had to consider whether you are a parent in relation to a particular investment if the investment was more than 50%. Now it's not like that. You will have to look at probably all your investment, maybe even 5%, 10%, because certain other criteria might establish the principle of control. So therefore, the onus of IFRS 10 is on the parent entities or the investors and not the subsidiaries or the investees. So therefore, the requirement is on the parent. A parent is required to prepare and present consolidated financial statements. So therefore, the exemptions or the scope outs that we discuss here will apply to a parent. So once the parent is exempted, then the consolidation of subsidiaries, that question will not arise. So the first category of exemption is where a parent who would satisfy few conditions, particularly 4 conditions, and all these conditions must be satisfied. In other words, standard uses the phrase if and only if. So if and only if a parent satisfies all these 4 conditions. So there are 2 parts. If a parent satisfies all these conditions, only if a parent satisfies these 4 conditions. What is the difference between this if and only if? if you satisfy these 4 conditions means there is a possibility that there could be other conditions also, right? So, if you satisfy these conditions, you need not prepare consolidated financial statements. But when you bring only if, there can't be any other condition which could permit a parent not to prepare consolidated financial statements. So, only if means only under these circumstances you are permitted to exempt, you are permitted not to prepare consolidated financial statements, but nothing else. Okay. So, what are these conditions? Now, this exception was there in IFRS 27 also. So, there is no difference as far as this exemption is concerned. When the parent is a wholly owned subsidiary of another entity or partially owned where other investors do not object to non-presentation of consolidated financial statements. So, in other words, can all of you see? Now, if there is a parent, now the entity has established the fact that it is a parent, it has subsidiaries, right? But that parent is in turn a subsidiary of another parent, right? And the relationship between these two is 100%, right? So, you have a parent which has subsidiaries below it, but that is another subsidiary of another parent who owns 100% of this subsidiary. So, the logic is that this particular parent has only one single shareholder. So, the question is, for this one single shareholder, do you need to prepare consolidated financial statements? The answer is no, because you know the general purpose financial statements are prepared for stakeholders or shareholders who have no right or ability to demand specific information, right? Now, in this particular situation, the logic is this one single shareholder has access, because it is the parent and has control, has access to any information about this parent and its all subsidiaries. So, because of that, there is no point in preparing general purpose consolidated financial statements for this one single shareholder, right? So, therefore, because of that, the standard exempts that kind of a parent from the requirement of preparing consolidated financial statements. But of course, this particular logic may not be held valid in certain circumstances. One is when your debt or equity instruments are publicly traded. Now, equity instruments, now you might ask, okay, if there is only one single shareholder, how can equity instruments be traded? But you might have a situation where even though voting shares are in Sri Lanka, this may not be possible by the stock exchange, but there could be a theoretical situation where your ordinary shares are fully held by one party, but your preference shares may be traded, or your debentures may be traded, which means you have public accountability. Now, even though you have only one single shareholder as far as voting shares are concerned, there are other interested parties, the debenture holders and the preference shareholders, who may not have the ability and the power to demand specific information with regard to the entity. So, therefore, you need to prepare general purpose financial statements. So, in situations where your debt or equity instruments are publicly traded, then this exemption is not available. Then secondly, if you are in the process of listing your debt or equity, you may not be listed at the moment, but if you are in the process of going for an IPO, for the purpose of preparing your prospectus, if you have to include financial statements, you can't take the benefit of this exemption, because the prospective investors will be looking at your financial statements in making decisions whether to invest or not. Lastly, you have to make sure that its ultimate parent, because sometimes you might have an interested party. In the framework, we identify certain interested parties other than shareholders. Therefore, for their benefit, you need to make sure that at least the ultimate parent is preparing consolidated financial statements, right? Now, if you look at few examples in the cases and examples that have been given, some practical issues with regard to this scope exemption. Actually, you can't, if we go by the general principles, to establish control you need more than 50%, right? But later you will find that even without 50%, maybe with 40%, maybe with 30%, you might control. So basically, when you say no objections from other investors, it has to be virtually all the investors, right? But depending on the materiality, say one particular investor holding 0.001% objecting, actually if specifically objects that kind of a shareholder, then you will have to look at the legal implications, right? But if he is silent, whether his no objection is essential in writing or whatever form is required is a judgment that you have to make, right? So, but virtually all the other shareholders should be okay for you not to present the financial statements. Actually, look at the logic. The logic is whether the shareholders of this particular entity, why they need general purpose financial statements, because they are not in a position to ask for specific information. Now, that other shareholders, if you provide all information that they ask, probably some of those shareholders having large stakes may be on the board also. So, in that case, they might not be interested in this consolidated financial statement. So, always we have to look at that aspect, whether those investors, whether those other investors have any interest. Are they in a aren't they in a position to demand for information what they need? Then only they will need this general purpose financial statements. Okay. Right. Now, if you look at example 1, if the ultimate parent's year end is different from the intermediary parent who is using the benefit of this exemption, what would be the situation? If entity IP1 is an intermediate parent company wholly owned by entity UP1, ultimate parent, and entity IP1's reporting date is 30th September and UP1 is 31st December. So, which means technically IP1, who is trying to get the benefit of this exemption, is publishing its financial statements as of 30th September. But the ultimate parent is publishing its financial statements 3 months later on 31st December. So, is it a barrier to apply this exemption? No, because the standard doesn't say that the ultimate parent has to publish its consolidated financial statements on the same day as the intermediary parent who applies this exemption. So therefore, the fact that the ultimate parent's year end is on a later date than the year end of the intermediary parent does not preclude the intermediary parent from using this exemption. Now in IAS 27 you would note that there is another provision where it says even when you consolidate a subsidiary, the difference in year end is not material. You can consolidate a subsidiary if the year end is not the same, either by using management accounts or by using last available annual accounts with adjustments to material transactions, right? Because at this stage, even though it may not be possible to draw a clear line, you need to differentiate the responsibilities of the preparers of financial statements and the audit. Now, preparation of financial statements has to be independent of the audit. Now, here we know every time when we have to consolidate, we ask for the audited financial statements of the subsidiary. Now, as far as an independent preparer is taken into consideration, the preparer is responsible to prepare financial statements. So, when he is preparing his own financial statements, first he prepares the financial statements and then only the audit comes. Similarly, when you are consolidating, you can consolidate with any set of accounts of the subsidiary. It need not be audited accounts, because audited accounts are not generally expected to be different from the accounts that you prepare. So therefore, consolidating with any set of accounts is not a problem, should not be a problem. Right. So I think we are not yet used in Sri Lanka to this concept of total independence between the preparer and the auditor, but it has to be. Okay. Second example, entity IP2 is an intermediate parent company wholly owned by entity UP2. From entity UP2's perspective, entity IP2 and its subsidiaries are immaterial. For this reason, entity UP2 does not actually consolidate these entities. Is use of the consolidation exemption by entity IP2 possible in this situation? What do you think without looking at the answer? Can the intermediate parent avail of the exemption or no? Okay, look at it from this perspective. Now, in the perspective of ultimate parent company, this intermediary parent and its entire group is not material, right? Now, let us say, in order to make use of this exemption, the ultimate parent consolidates, even though it is immaterial, consolidates this intermediary parent and the subsidiaries. Let us say they consolidate. Then is the exemption available or not? It is available. Theoretically, it is available, right? But in the perspective of ultimate parent, if the consolidation of this intermediary parent is not material, is there any use of this consolidation to any decision maker by using that financial statements of the ultimate parent? It's not material information. But simply, on a technical perspective, if you consolidate, you have this exemption. If you don't consolidate, you don't, as you said, you don't have this exemption. But whether you consolidate or not, the users have no benefit. So in that case, should we pursue this consolidation to avail the exemption? Not required. So therefore, one can argue that even if the ultimate parent does not consolidate due to materiality, still the intermediary parent can use the exemption provision. Sorry? If it is, I mean, all these 40 standards apply only to material transactions. If something is not material, none of these standards would apply. So that is the other important area where the focus has to be established, or you have to pay attention when you apply all these standards, materiality. Lot of judgment is required. Again, I would try to draw a line between the audit materiality and the preparer's materiality. So two different things. Third example, entity IP3 is an intermediate parent company wholly owned by entity UP3. Both have a reporting date of 31st December. However, entity IP3's filing deadline is 3 months after year end, and entity UP3's filing deadline is 6 months. Now, this may not be applicable in Sri Lankan scenario. Both entities file financial statements on the legal deadline. So entity UP3's consolidated financial statements are not available for public use when entity IP3's financial statements are filed. So take a situation where ultimate parent and the intermediary parent publishes its financial statements on a particular date, and the ultimate parent's financial statements are not available on that date. It will be available sometime later. So is it a reason that would preclude this exemption? It is not, because IFRS 10 does not talk about a timeline for this particular exemption. So therefore, the fact that the financial statements of the ultimate parent are delayed beyond the date of publishing the financial statements by the intermediary parent does not preclude the intermediary parent from availing this exemption. What is required is for the ultimate parent, provided it is material, to consolidate this and publish financial statements as per the rules applicable for the ultimate parent, not on the same day. Any questions so far? Right. So